Is hyperinflation coming 2021? Today we speak about helicopter money, we will speak about money printing, about inflation and hyperinflation. We have Silvan, he's a very expert asset manager, and he prepared 8 charts for us, 8 very interesting charts speaking about the markets, how the markets are reacting in this COVID-19 crisis. And then what is very interesting, we are analyzing also what happened at that day when the vaccine has been announced. Which were the good companies, which were the bad companies at that day. And now comes the bad part. At the end, we will tell you exactly how you should invest to be prepared for the end of the COVID-19 crisis. We will tell you how to survive the COVID-19 crisis and how to invest for the period coming after the COVID-19 crisis. Stay tuned.
Caputo and Partners, SwissBankingLawyers.com. We fight for your money.
My name is Enzo Caputo. I'm the international private banking lawyer, the founder of SwissBankingLawyers.com, the place where international business people find tips and solutions how to better protect their assets with Swiss banks and pay less tax.
We fight for your money.
Hello, Silvan. It's a great pleasure to have you on the show today because you prepared 8 very interesting charts about the 2 days market situation. You will tell you exactly how the market are reacting, how the market reacted when the vaccine has been announced, and what we should do, what we have to do as an investor to survive the COVID-19 crisis and how to invest after the crisis. What will look the world after the crisis.
Yes.
Thank you very much for being with us. Thank you very much. It's a great pleasure to have you today in our show. Hi, Silvan. The markets have recovered very strongly and the sentiment seems very strong at the moment. What do you think about?
Yes, I mean, it's how it usually is, right? Few people actually foresaw recovery on that scale. I mean, it was quite strong, the recovery in the stock market. But as we always say, I mean, markets, to time markets, it's a very difficult thing and it's best not to try it. So, yes.
Okay. Nevertheless, Corona is hitting full force again. Corona has full power in Europe and devastating effects also in the USA. We have to fear another slump. We have to fear another crash. What will happen?
Yeah, I mean, another slump that could indeed happen if one sees how the government reacts almost in panic to reduce the number of infections, right? In my view, it's likely that the markets will again react negatively to new lockdowns, but I believe we will not see the March lows again.
Okay, and why not?
Well, I guess the rescue programs from all over the world, basically, but especially in the EU, they are so enormous that things only can turn out well, at least in short term. But by that, I already mean a few years. So for that few years, I see a very positive stock markets.
But we had the time you were more negative.
Yes, that's true. I mean, but it's also not normal that governments put together rescue packages that are so big. I think there has never been anything like that in history, but we may come to this a little bit later.
Okay, but you also have some PMI numbers prepared, and they don't look so good right now. Isn't the rising virus count not a very bad signal?
Yes, sure. I mean, I can show you the chart again. We already looked last time at PMI numbers, but so if I start here from the beginning, first chart, then I mean you see the numbers here. Probably I come quickly to the PMI. What it means? It means Purchasing Manager Index. I mean that's a leading indicator, meaning that it rather shows the next 3 months and not the past 3 months, or at least it should show. And you have here numbers on the left scale, and when it is above 50, that means the economy is expanding, and when it is below 50, that means the economy is shrinking. How it is done, this chart or this index, they usually ask 400 executives from company in 19 primary industries, so not just one industry, so it's very diversified, the survey. They ask how they see the business. And, I mean, that they have different things they ask. For example, how are the new orders? How are the inventory levels? How is the production going on? Supplier deliveries? How do you see the employment? Will you rather hire or will you rather fire people? And all things like that.
Very interesting information. Very interesting. And what can you read about these numbers? What can you read from these numbers?
Well, it actually shows a little bit what we have feared and also discussed in other videos. All countries that had decided to do a lockdown, and that were almost all countries in Europe and United States, not a 100% shutdown, but I think they also closed some countries there, some states. But in Europe, we really, all of the, except of Sweden, we had lockdowns, and of course it's not surprising that you see here a drop from, I mean, that was here even very good numbers, expect of Switzerland here, but EU, the big countries in the EU were all above 50.
Very fast drop, and that's a very fast drop.
And then we have a very crazy drop, never seen something like that.
But also a fast recovery.
Yeah, below the 10, right, here in Spain, I think, if I have it correct in my mind, the low was somewhere at 8. And
wow.
Then Germany was a little bit above yeah. 10, but it was very, very low. And then we see only 3 months later, Germany very strongly recovering. That's the blue line, no, that's France. Germany is the green line, but France as well. We see here it goes to 55 only 3 months later, so that's quite impressive. But what I think is more alarming here is that while the countries like Italy, that's the brownish black line, and Spain and the yellow, so they just came for 1 month above 50, and then they already going down quite strongly. I mean, that would already be a recession during normal times. This chart, it looks that is nothing, but when you drop from 52 to below 45, that would already be a kind of bigger recession. So yeah, that's why I'm a bit worried.
So and how do you see the markets in the next 12 months?
Well, it's hard to say, as always, but I mean, of course, those signals they don't look nice now, but the rescue programs, the aid programs of the EU, it's that big. They really took out the big bazooka this time. And they call it the Pandemic Emergency Purchase Program. So that's the EU-wide aid program. And this program alone is 750 billion big. I mean, that's already a number, right? And then,
crazy number. Yes.
And then additional, we have the national programs. So of each country, they have some kind of programs also. And those are also quite big. How big those numbers are, that's quite different and also hard to say, because it depends what you include in the calculation. But if you take Germany, for example, they make up almost 40% of GDP if you take everything together. And I would say that probably 20% for every county in the EU, we see at least 20%.
Yeah.
And now we can put together these numbers, right? So if you calculate the official program, the EU program to the national programs, then you get a number, and we see that here. So this is the EU-wide program, the Pandemic Emergency Purchase Program, and then here the national programs. And this is the GDP of the EU, the 18,000 billion or 18 trillion. So that's basically 100%.
18 trillions or 18,000 billions,
Yes,
correct?
yes, correct, yes.
That's a huge number, a huge number. This is the GDP of the European Union.
Mm-hmm. So then,
and then we have the national programs also.
Yes, and here just as a comparison quickly, the lead program during the financial crisis 2008, they came up with 215 billion. So that was 1.2% of the GDP at that time.
Wow.
So now the Pandemic Emergency Purchase Program with 750 billion, that's already 4.2%. I mean, that's 3 to 4 times bigger than what we have seen here, right? No. And on top of that, we see the national aid programs. They certainly come with 3.6 trillion or the 20% calculated of this 18 trillion. And that makes then almost 25% of the GDP of the EU. I mean, I have never seen such numbers before.
Yeah, this is unique. And the source of this information is the European Central Bank itself, correct? Because here source ECB European Union.
Yes, correct. Yeah. And now coming back to your question you had before, how will the market react? I mean, the market will probably short-term react negatively to new lockdowns, but sooner or later one have to learn to live with the virus. When it will not go away in the next week. So in Germany, for example, the healthcare system is far from being overloaded, even if the numbers are again rising exponentially. Now today they are a bit better and going down, but they were now up every day the last 2 months, right?
Yeah.
So we have to live with the virus sooner or later.
Yeah, but we had the vaccine, we had the vaccine. It had a big impact on the markets too recently.
Yeah, on Monday, Pfizer came out with BioNTech. They have a corporation, and they brought out very good numbers for a vaccine. That is quite of hope, and the market also reacted positively to that news. Yes.
Very interesting. Very interesting. And later you show us a chart of the winning company and the losers.
Yes, at the end,
We'll have a look on these charts. Okay, but there are rumors that the active ingredient will only be useful for a short time. In this vaccine, there are rumors that the active ingredient of this vaccine will only be useful for a short time. What do you think about?
Well, that could be, but what I want to say is, I mean, the numbers of the vaccine, I'm not an expert in this field, but I was until recently indeed rather critical that the vaccination will come and above all be effective. And that's two things. Will we have a vaccine and will it be effective, right? I mean, just look at how difficult it is to make a vaccine for the seasonal flu. And the research has been going on for decades there, right? But the data from Pfizer and BioNTech were really promising. And they took 43,500 people into this phase 3 study. So they were volunteers. And half of them received the vaccine and the other half received the placebo. And the data showed that over 90% of the volunteers that received the vaccine did not get corona. And the researchers had previously calculated that corona vaccines were about 60 to 70% effective. So the results of Pfizer and BioNTech study showed really that the effectiveness and the vaccination is very good. So yeah, that makes some hope, and this could indeed be the case that the vaccine just lasts for 2-3 months, but even that would greatly limit the spread of the virus, and that could even lead to a total extinction of the virus. But it must also be We must also be clearly said that those are first and early data. Of course, there could still be major side effects that are not yet known, but it looks really good, yes.
Okay, it looks good, but despite that, we have to live with the virus. Maybe a little bit better, or maybe not so good. So if the vaccine is here, it will be positive, but that the virus will be eliminated from one day to the other, this is quite impossible at this very moment. Correct?
I mean, that will certainly take some time, not just to get, not just to make the vaccination, but to have it around worldwide, right? That takes 6 months.
Let's assume all these coronavirus crisis is over. What happened with the markets? What happens then when everything is over?
Well, I would like to answer these questions with a counter question. Imagine a population that has been more or less imprisoned for almost a year and spent less money and stayed at home, as they said,
Yes.
and now all of a sudden they can go out again with a pocket full of money they get from the States, from the EU, and from the national programs. Yeah, what would they do?
I would assume they go out, they make parties, they consume, and they travel.
Yeah, that seems very logical, isn't it?
That sounds fantastic. Or do you may see a problem?
No, I think, I mean, that's certainly good for the markets until the headache comes the next day. I actually think it has become very likely that we will see a consumer boom. Presumably goods such as travel, restaurants, events, concerts will be in particular high demand, I guess.
Yeah.
Typically, consumer goods that could also be bought during the crisis will probably also have a higher demand, but I guess less than other goods, and then it becomes probably that we will see a rapidly rising inflation.
The stories about hyperinflation because of money printing have been heard since 2009, and the fears never came true.
Yes, I mean, you are totally right with that. And I also do not see higher inflation when the companies cannot push through higher wages. Then it will not come, certainly. I have also here a chart that shows a little bit the history about inflation.
Here we see the history since the 70s. So the chart goes from 1971 to 2020.
Yes, and we had a period here that is quite a long time back, but there this was a little bit a special situation because the government, or also the central banks, they thought that they can lower unemployment numbers when inflation is high. So even though they had rising inflation in the beginning, they did not raise interest rates. And I mean, that was, of course, a wrong decision, as we know today. And at the same time, the Bretton Woods system also fall, and that happened. A crazy high inflation. You see it here, about 14%. And yeah, I mean, I don't think that we will see that again. But yes, so this phase here, I did not much analyze now. But in this phase, that's certainly possible that we see here hikes from basically 0 or 2% or even a bit below to above 4 or 5%. That could definitely happen. Here was also the monetary policy was very expensive. I mean, the lowered rates here relatively quickly when you come from 9% to 6%. The blue line shows the federal funds, the target rate, the left scale. So there are upper bands and lower bands, and this is the mid. And the yellow line shows the inflation. That's the US Consumer Price Index. And red here that shows the difference. So if the interest rates are higher than the inflation, you have a positive spike here on the red, which was the case all this period here. And when the blue line is lower than the yellow one, so that means also for savers or people, they have money invested in bonds, that they actually lose money because inflation is higher, so basically here, than what you get on your account or with bonds, because interest rates are lower than inflation.
Yeah.
So there was another period here, we had quite high inflation, or it was going up relatively quickly. That was 2003 to 2008. Then we had the financial crisis, then it dropped again. And here we had also too expensive monetary policy. And those were the two phases, I would say, that could be a really realistic scenario of what we will see in the past, in the coming future. Excuse me.
So what should an investor do then to protect himself against high inflation? How should he invest? What should he do?
I think if this scenario occurs here and prices go up, then we should quickly look also at these two phases, what the different asset classes did. So I would go a step back here with the same graph, but I analyzed here, for example, the stock market. But here you have the same time horizon and the same graph on the bottom here.
The stock markets during periods of hyperinflation.
Yes, of course.
Very interesting, very interesting.
And here from 87 to 91, for example, the stock market performed very well. I mean, it was on average, you see that here, it was about 12%. I mean, that's quite a return you get, especially when you look at the interest rates, how they drop. I mean, when you here get 12% relatively in a stock market, then it's not so much when interest rates are at 9, but when you get when they are at 3, then it's of course a lot. Here you see also the sectors. I mean, that's not surprising to me. The consumer staples performed very well. This includes stocks like Coca-Cola, like Colgate, like Unilever. In other words, companies that sell products for their everyday use. And those stocks increased by impressively 26%. So that's the annual return here. So this is the performance over the whole period. And I mean, that's really good, one has to say. But it's somewhat logical. I mean, if prices increases or take place, then it's logical that they occur primarily in products like this. So if you have to buy a soap, then you buy it. Doesn't matter if the price is higher, right? So, and not surprisingly, healthcare, it's more or less the same. So drugs you also need all the time, and the prices here were or the performance was over 22%.
Very interesting. And how did bonds perform?
I would show you bonds a little bit later, but come to the phase here.
Yes.
I mean, it was a different story, because here, and we see that later with the bonds you just asked for, how here was one says the real interest rate. So real interest rate is this the red one. Meaning the interest rate minus the inflation equals the real interest rate. That was positive on over this period, and it was also, we see here, it was also positive, but here it was negative, and here it was negative. For this example here with the stocks, the results are not that extreme, but you see it afterwards for precious metals and for bond, it was very different. And during that period, I mean, here was already 2008 a little bit included, and we already had the stock market crash that began 2007. But still, the stocks made 2.3%.
Astonishing.
but it's not surprising that the sectors changed somewhat, because it was a little bit a different story at that time. We had a real estate crisis in the US, and so it's not surprising that financials lost 43%, because 2 years of the crisis were already included in this analysis, and real estate also lost about 40%.
Yeah, there was the mortgage crisis at that time. We had the mortgage crisis.
Yeah, exactly. Yes,
I remember exactly. And what was the performance of bonds in history?
Mm-hmm. So this chart here should show the bond performance.
Yeah.
I took for that the aggregate bond index. So here in this index included our government bonds of the US government, as well as corporate bonds. And what we have to say before we start with analyzes the data, when interest rates go up like here, then bonds usually perform bad, because you have high yields in the market and you are in a fixed yield environment when you are invested. When interest rates go down like here, then bonds perform very well. And that's also what we see here. So from 87 on, you see rising interest rates, and you see that, and here the bond index was rather flat. And then from 88 on, so about here, interest rates were falling really deeply and quickly, right? So this created a rally in the bond index, and this is about the 55% performance over that period. So quite good. And that's what we also saw during that crisis here.
During the financial crisis, yeah.
During that phase of inflation, I have to say, not crisis.
Yeah.
So that started already 2003 with inflation going up. So the yellow bulk here should be a little bit earlier. But you see here the yields were still dropping. So that's what we see here, this spike. And then interest rates go up at this, and here you see also a rather flattish performance. But after that, of course, interest rates went down again, and the performance was also positive. But here we as this graph shows, I explained that a little bit later. But the performance was not that good for a bond. The reason is, and this is what the red thing here shows, because the reason is that real interest rates were not that positive than they were here. What are real interest rates? Real interest rates are the federal interest rate, so the blue line minus the yellow line. So if that is positive, this is very good for bonds usually, and if that is rather negative, then it's not so good. And that was the reason bonds performed better during that time. But to be honest, it was a relatively good performance for both periods.
Okay. What about gold? Let's assume the COVID problem is finished and everything is solved with COVID. What about gold? What will happen with gold? Precious metals performance during periods of hyperinflation. So what will happen with gold?
Yeah, that depends a little bit. I mean, gold is known as a good inflation hedge, but that isn't always true. If the real interest rate, as I just explained, it's the red one here, is very good or positive for the investor, then gold is usually a not so good performance. So we saw that 87 to 91, when we had real interest rates of 13 to 17, 18%, or 15, sorry. Then precious metals were negative, and they started already very early. You see that that was the high, 87. We had here about the same or even a little bit higher value. But from then on, gold prices went down. Here a little spike, but down again the following years. And that's that's a little bit something from 100 to let's say 83 or so, and for the silver it's even more extreme.
They lost in value, yeah.
But let's take this example here, and that's what also I think is more likely we see in the future. Here we had negative real interest rates, or just for a short term positive, and here gold performed very well. And you probably see that. Let's take this as an example: 05 to 07, 08. Yes, you see that also here. So it's really quite, you can really see that from 07, 05 to at least, yeah, here the performance started to get a little bit better when interest rates started to fall. But from here, at least to here, performance was also rather flattish. And then from here on, from middle of 06, 07, let's say, when interest rates started to fall and the real interest rate got positive, then you had quite an increase in gold prices as well. So this was a very nice performance, with the top ending at 270%, and even better for the silver.
Very interesting, very interesting.
So going forward, I mean, for the gold, I would say, and I speak a little bit more about that later, but how likely is it that the Fed will raise rates even when inflation is going up? And I don't see that very likely. I mean, it can be that they adjusted a little bit to the upwards the interest rates, but I think it will.
So you don't see definitely no hyperinflation, correct?
I'm speaking now about the interest rates, because I made here the correlation with falling interest rates and the gold price movement upwards. And I don't see that the Fed will raise interest rates like this period. I don't believe that. Could be that we see a step to 2%. That could actually be, but I don't think that interest rates are going up to 4.5% again.
Okay.
While the inflation rate, they could be positive and go up. So I definitely see that, as discussed before. How much? I don't know. It could be 4, 5, 6%, absolutely. And then we have a very negative real interest rate scenario. So that would really speak for precious metals.
Yeah. Wow, very interesting. And what about the real estate market? Do you still believe that real estate is a good investment, especially for Switzerland? My private opinion is I think it's a good investment, especially investing in real estate in Switzerland. But how do you invest in real estate for your clients, Silvan? And what do you think about real estate?
I still think what we also have discussed in earlier videos, that it will be a good investment. I will show that here, and here is the situation. A little bit similar to gold sometimes, to precious metals. But real estate had a little bit an exemption the last crisis, because here real estate performed poorly because of the positive real interest rate scenario, as it was with gold. So meaning that the interest rates were much higher than the inflation rate. So people think, why should I hold real estate, because I'm already getting at the bank account 14% and the inflation is just 4%. Why should I buy a house? Right? And that's for me totally logical. And with the precious metal, exactly the same, because gold has no yield. And when you get in real terms, so it's 13% return, why should you hold gold? So that's for me absolutely explainable that real estate performed badly during that time, and it was down. And here real estate also performed badly during the financial crisis, and this is also absolutely explainable because we had the financial crisis here in the US, and that was actually a real estate crisis, so that was the source of the crisis, and that's also logical that real estate can perform well. And we see that here, that they lost 39% during that period of time, but I said it's logical because it was a real estate crisis.
Excellent, excellent.
So here I made a little projection, a little less estimate how it could go on forward. So
Yes.
could be that federal funds target rate, meaning interest rates, go up a little bit, but I see inflation rates in the scenario of 2 to 5% possible. So that means when the rates stay the same and inflation is going up, that we have a very negative real interest rate scenario. And that actually would lead to higher gold prices. As said before, it would lead to a very good performance in real estate as well. And I see rather this scenario coming.
So real estate and gold is a good investment. Real estate, obviously, when you invest in real estate, you have to be careful. You have to diversify. Don't put all of your eggs in one basket. You have to diversify. When investing in gold, also there are also some rules to follow. But in generally spoken, real estate and gold both are excellent investments for the future and even for times after COVID. And also good quality shares. Correct, Silvan? Even good quality shares.
Yeah, I mean, as I showed in the first charts here, I mean, shares did always do well during times of rising inflation. I guess that will happen again.
Yeah.
And I will do or say one more thing. And
yes, this is very interesting. When the vaccine came, what happened with the?
I mean, let's say that will happen. What we said, and we'll have a vaccine, and Corona is gone sooner or later. What can we expect then?
Yeah.
Then I think it makes sense to make kind of inflation trade.
What means inflation trade? What do you mean with inflation trade?
I mean, what would happen, as you said before, when Corona is not here anymore? People will go out, they will travel, they will make party or have party, they consume, they go to concerts, to events, and so
on. They drive more cars, they use more gasoline. They need more gasoline. Oil and gas prices are more requested. Gasoline is more requested. Aircraft are more requested.
And the first move we have already seen on the 9th of November. That was the day when Pfizer announced the vaccine study. Or give out the guidelines. And you saw that airlines dropped year to date. So this performance here is a year-to-date percentage performance. Airlines are down 35% year-to-date.
It's the 9th of November, 2020. Yeah? This is the day when the vaccine was.
But on that day, they went up 20%. So that's the industry now. There are 3 companies just included. I took Europe here, not the US, and you would have more. But in Europe, we have 3 big airlines, and I took those 3. And the average performance was 20% up. But year to date, it was 35% down. So,
but also equity real estate investment,
Yes, but what I want to say here is let's assume that everything happens. I mean, then I would like to have also part of I want to be part of the rally, right? And that's most likely to happen in industries that were beaten down during Corona crisis. And then I would want to have some investments in those industry as well, because those are the most likely ones that go up. So meaning probably airlines, I'm not so big fan of airline investment, but oil and gas anyway looks very cheap currently at the market. Probably I would have an investment there. So I would
very interesting.
And probably banks as well. I mean, banks in Europe, and this is also, that's just banks in Europe, they are down the last 10 years, right? So the valuation there is very cheap. And when Corona crisis is gone, it's very likely that banks go up. So that's the first time in a decade, probably I would recommend banks. Transportation is clear. People are, I mean, basically those are the industries.
Huge potential to recover. They have huge recovery potential,
The fallen angels.
Yeah, the fallen angels, exactly. Very interesting.
So that's it.
Thank you, Silvan. Then we are very curious. We are very curious what will happen.
Mhm.
And thank you for your input. So if I can summarize, to be protected, to be always on the safe side, you should invest a part of your wealth in shares, in high quality shares. Some part of your wealth invested in real estate. You do it in Switzerland. For foreign clients, you invest in investment fund holding Swiss real estate, because Switzerland is a small country, so it's a good place to invest for real estate. And since the COVID crisis, we have high demand from everywhere, from the whole world. Many people want to come to Switzerland, so Switzerland is the Rolls-Royce destination for high net worth and ultra high net worth individuals, definitely. And then you suggest also gold. Gold has also huge potential. Precious metals have huge potential to be a good investment, even when this Corona-19 crisis will be over finally. If you like such kind of information, don't forget to subscribe to our YouTube channel. Click the subscribe button now and subscribe to our YouTube channel. You know, information just like this, you cannot find in universities, you cannot find in libraries and in bibliothèques. If you like information just like this, please subscribe to our YouTube channel and ring the bell. By doing so, you will never miss a new video. Thank you very much for having been with us today. If you may have a question to Silvan, if you may have a question to me, grab your mobile phone and dial 00414421244404. Give me a call. We are always here for you. If you want to protect your money better, work with Swiss bank, protect your money with Swiss banks, and you will have my support for account opening and Silvan support for successful asset management. Thank you very much for having me with us. See you next time. Stay rich and be rich. Have a wonderful day.
Thank you, Enzo. Bye-bye.
Thank you, Silvan.